What actually is private equity?
We take other people's money. It tends to be pension funds, big family offices, and they say, we'd like you to go and invest that money into private businesses.
So if I'm coming to pitch to somebody like you, what's the 3 or 4 things that I've really got to do to tick the boxes? And what's the one thing that please don't do that?
So the one thing please don't do is don't come in and tell me the story you think I want to hear.
Be careful of exaggerating too much.
Yeah, I only see about 1,500 new opportunities a year.
Wow.
So it's a big number, but we've got a big team. 40.
That's like 30 every week.
Yeah.
Welcome to Billionaire Business. My name is Ian Fishwick. I'm a serial entrepreneur in the UK IT and telecoms industry. When I look back across my life, it dawned on me that I've raised money in all sorts of ways. I've had family and friends help. I've had shareholders when I run public companies. I've had banks, obviously. But I've also had venture capitalists, infrastructure funds, and private equity.
And I'm Chris Godsmark, and I've been advising on mergers, acquisitions, fundraisings, IPOs, pretty much everything for well over 20 years. I must have done over 200 deals, if not 300 during that time, and a lot of them with entrepreneurs like Ian.
One of the big changes over the last 15 years, particularly the last 10, has been the absolute rise of private equity. Most estimates now say that roughly 1 out of 10 people in businesses in the UK work for a business that's owned by private equity. And to put that in context, that's something like 2.5 million people. But if you ask them to explain what is private equity, that's a bit different. So this episode is designed to demystify and simplify what is private equity. And that's why it's a huge pleasure to welcome the managing partner of YFM Equity Partners, Jamie Roberts.
Thank you for having me.
Jamie, great to see you, and thanks for coming on the show. I think we've got to ask the question at the beginning, what actually is private equity?
It's a good question. It's a question that my children will ask, and they go into school and they say, what does daddy do for work? And then they come home and they say, he mostly eats cake and has meetings. There's slightly more detailed answer than that. So private equity, we take other people's money. So people invest in our funds, and they tend to be sort of traditional private equity is fixed life funds, so 10-year funds. So the people give us that money. It tends to be pension funds, big family offices. They'll give us the money and they say, we'd like you to go and invest that money into private businesses. So we're going to back you to find really interesting situations, really interesting businesses, invest in those businesses and go on a journey with the management team. And at some point at the end, have some sort of an exit event. And then we give that money back to the investors in our funds.
Where do you get your money from? Who are your investors?
We have 2 strategies, I guess that's probably how we think about it. So we've got the buyout funds, which are investing in businesses making sort of £1 to £5 million of profit. And we tend to be investing in a business to back the management team to buy out the founders, tends to be what we're doing. Or it's a founder saying, I've created a load of wealth and I want to de-risk myself. So I'm going to sell half of my business to YFM and they're going to come on the journey with us. That money comes from a mix of pension funds, there's some big family offices, well-known family offices, and then some high net worths. So it tends to be first generational wealth people. A lot of them we've known, we've made money with in transactions before. So that's half our business. The other half of our business is something called venture capital trusts. So they're listed vehicles. So they are listed on the London Stock Exchange, full list. People buy those shares, a tax-advantaged fund. So it's a bit like EIS. So individuals...
It's like having an ISA, isn't it, effectively? It's that kind of, tax break, effectively.
Yeah, there's a tax break in there. So you you buy the shares and you can claim back, or most people are able to claim back 30 pence in the pound on their tax bill for investing in the fund, and then some of the returns are tax-free. But again, 2 different pots of money, but essentially doing the same thing. So investing in private businesses in the UK to help the management teams make those businesses more valuable at a point in the future when we get our exit.
I mean, one of the things that's interested me about YFM is that you're one of the oldest private equity fund managers in the UK. I mean, you've been around since the early 80s, right?
Yep.
But you're still backing... I mean, you're going to tell us about YFM, right? But you're still backing smaller businesses and in some cases, really quite small businesses that are not startups, but are not far away from having been startups. Whereas a lot of private equity funds over the last 20 years, there's been this huge gold rush in private equity, and they've gone from maybe having a 200 million fund to a 10 billion fund over the course of 15 or 20 years. You guys haven't done that, have you?
No, it's a question that we ask ourselves, really, why we haven't done it. We've never thought to do it. It's not really in our DNA. So we talk about ourselves as being a regional investor. So we've got offices in Leeds, Manchester, Birmingham, Reading, and then in London, very much focused on the local community of advisors like yourselves, lawyers, headhunters who bring us opportunities. And we really like that bit. We really like working quite closely with the entrepreneurs, businesses that are going on quite an exciting journey. It's quite exciting backing a business and sort of strategically involved, but we're not operationally involved. So you sort of get some of the highs and you get some of the lows, but it's a really fun thing to do. And because it's a really fun thing to do, and because we're pretty good at it, we've never really had the urge to go and try and do something materially different. So as private equity funds get bigger and bigger, it becomes a bit more numbery, a bit more accountants. It's a bit more buying a business that's already great, and we're going to put in a load of bank debt, and we're going to do some clever structuring, and we're going to have some beautiful models, and we're all going to be very clever, and we're going to deploy lots of money. And in 5 years' time, as long as the economy's done really well, we'll be able to sell it and we'll pay off some bank debt. And they make their money that way, and that's awesome, and hats off to them. We're backing people.
I think one of the misconceptions is that private equity, they're all the same, and they're not, right? There are some people who operate buying giant businesses, some who do only, say, 25 million profit and above, some who do 10 to 25, some who do 5 to 10. Where do you fit into that? What's your sweet spot? Where does YFM sit?
So we're often the first professionally managed money that goes into a business.
So you're the first step into private equity, really?
Yeah, pretty much. I mean, there's some very big businesses out there now. There's a business called Fishwick, which is in the US, which is very, very valuable, has been sold recently for sort of mega telephone numbers. I want to say billions, but I don't know that, but huge numbers. We were the first people in that business when it was making about £1 million of profit a year. And I look at everybody has their part in the ecosystem, and our part is to find businesses that are good businesses with good teams who are going on that scale-up journey. We help them do the scaling up, but we also help make them look absolutely perfect for the next buyer, the next private equity fund.
The reason why I ask that is because a lot of people think that mistakenly, that you have to be absolutely huge before you start to even think about private equity. How big do you need to be for somebody to say, yeah, I'll talk to you?
Yeah, so I'd go back to our two strategies. So on the buyout side, £1 to £5 million of profit. That's if somebody's looking for replacement capital. On the growth capital side, that's very early. So that's businesses with about $1 million of revenue or $1 million of recurring revenue, sort of contracted recurring revenue. So they might not have turned it over yet, but they've got the contracts that mean they will in the next year. About 10 customers is sort of the low end of what we'll do. So a little bit of what we'd call product market fit. So very early, and that money is going into the business to accelerate the growth.
And you're generalists, aren't you, as far as I mean, you've got investments in a noodle bar, lots of B2B techie data businesses. Yep. You've got something in wastewater, yes, I think, drainage. Yep. Well, how do you manage being a generalist in a world where some of your competitors have got specialist people doing, just AI, for example?
Yeah, so jack of all trades, master of none is what, it rings of that, doesn't it? But we're not running those businesses. So we're backing the management team to run those businesses. So we're a generalist, but the one thing in all of them is there's great people so we're backing a business, but we're really backing the people that run it.
So how many businesses do you look at a year, and what percentage do you say yes to?
So we currently see about 1,500 new opportunities a year.
Wow.
So it's a big number, but we've got a big team. So we've got about 40.
That's like 30 every week.
Yeah, it's a lot, but we've got...
And how many do you do?
So we do, it's 1%, and it's been 1% for donkey's years. So when I joined YFM,
so 15 out of 1,500.
Yeah. Yep. Yeah.
So how do you triage them? Do you sort of have literally an initial triage where you reject 50% of them before you then have to go into a more detailed process, or how does that work?
Yeah, so we've got 45 investment professionals across the business, so 65 people in total. There's 45 people working on the deploying the money into new businesses and then working with those businesses on the other side. So 30 a week sounds like a lot, and then you say, well, there's 45 people doing it. So it's sort of one-ish a week per person.
Now, I get that bit, but 99% of people who you talk to or look at get the no. So what's the big red flag that says you're out straight away?
So if they don't hit our investment thesis, so if it's too big for us, too small for us, too early for us, if we've already got an investment in the sector, so we wouldn't invest in two businesses that compete because it doesn't feel like the right thing to do. If we can't see that business being 3 times more valuable than it is today, that's probably not for us. There'll be some sector stuff. So there's different times in the cycle you might want to invest in different things. It might not be a UK-based business. It might be there's no management team. So there's a whole criteria. But so that first triage that we talked about, the first triage is definitely does it fit our criteria? And do we think it looks interesting from a growth perspective? If it ticks those boxes, then we want to meet the team. And that's probably the most crucial thing for us is the people we're backing. So
and what are you looking for when the team comes in? You've done this many, many, many times. What are you looking to see in them apart from passion? I assume they're all passionate about their businesses and keen to get your money, right? But what else are you looking to see from them in that initial meeting?
So we want to understand the story. So why is this business going to be worth 3 times as much in 5 years' time as it is today? And we don't say 3 times, but we'll just say, just tell us what is it that's going to happen between now and 5 years that means this business is more valuable. And you'd be surprised, because it's all very numbery, our world. Everybody loves the numbers, don't they? You'd be surprised how many people can talk you through the numbers, but they can't talk you through the how and the why. So we're quite interested in the how, more interested in the how and the why than we are in the numbers.
If I'm pitching to you, does that mean that I have to start with convincing you that the market I'm in is a growing market?
No. So it's easier to grow a business in a growing market, but there's plenty of businesses that have been started in markets that are pretty saturated, and you can back a team to execute really well, to find their niche, to find a bit of that market.
But in a mature market, how can you spot who the winners are going to be?
So we do a lot of how are they making their money? So what is it they're actually doing? If somebody comes to us and says, it's just another Me Too, and somebody presents another Me Too, that we're going to do the same thing as everybody else does in a very busy market that's mature, that's going to be pretty tough. But if somebody comes to us and says, actually, this market looks like it's really well served, but the big companies are brilliantly served and the enterprise customers are really well served, but the micro SMEs are not well served, and our solution fills that gap.
So what are the themes at the moment that are particularly sort of resonating for you guys? And you did say there might be times where there are other sort of sectors or investment themes that you have invested in the past, but you're not doing so at the moment. What would the right investment areas be?
We do a lot of software. So we do a lot of B2B enterprise SaaS. And part of the reason we do that is because we're actually quite good at it, and we've had quite a lot of success of investing in businesses like that. So what we find is entrepreneurs come and find us and say, YFM, you invested in Matillion in Manchester when it had $1 million-ish of revenue, 10 customers. That business raised money in the US at $1.5 billion a couple of years ago. So people come to find us to say, you guys obviously did something good there. Maybe you can help us do that. So lots of B2B enterprise SaaS.
So let's do Matillion for a second, because that's one of your great success stories. One, explain what they do, and what was it that attracted to them that said, this looks interesting? Or was it just lucky?
Any investor who so when we're recruiting new people into the team, the number one, I want to see 2 things. I want to see grit. So I want to talk about people that, like, you've taught me through a time in your life that's been quite hard and you've got through it, right? Because life's difficult. So grit, and then luck. So I like working with lucky people, and you'd be surprised how many unlucky people you do meet in my world. It was all going really well, and then this bad thing happened, and then this was going really well, and this bad thing happened. people who have really unlucky stories in business are quite hard to back because you do need an element of
I
luck.
was just going to say.
Matillion. Go on. Do Matillion.
Yeah, so Matillion we were, Matthew Scullion's the founder. He'd appointed a corporate finance advisor who I knew. So Matillion's up in Manchester. So a chap called Eddie Harding sent me over the teaser. It was a couple of pages and said, this Matillion thing, Jamie, it looks awesome. And I was really busy. So we've got an office in Manchester, businesses in Manchester. So I forwarded it on to the lady in Manchester called Deborah. And I said, Deborah, this has just come in from Eddie. I really like Eddie. I've read it. I don't really know what it does. Do you want to could you pick it up, please? Because I'm quite busy. And then Deborah picked it up and she met Matthew. Matthew's a very, very impressive, very, very impressive guy who had a vision and was basically saying the companies who digest lots of data, it's too slow for them to drag it in and out of the cloud. I'm not particularly techie, so I'll be saying this all wrong, but it's not quick to get data in and out of the cloud. And Matthew was building some software that would make that happen. And he was impressive. What he was trying to do was impressive. And the customers he'd got on board were really, really validated what they were doing. And it exploded. So we did 3 rounds, I think, before it went to the US. And then they raised a couple of $100 million.
So let's do that, because if you've done 3 rounds, then obviously you do follow-on money sometimes. Yep. Right. So what's a typical check size from you guys?
So on the way in, on the growth capital side of our business, we can do 3 to 20. But on that first check, we're probably doing 2-ish to...
million.
Yeah, 2 million to 10 on the way in. But it's mostly
is it minority stakes or majority stakes?
On the growth capital side, yeah. On the growth capital side, we're putting money in to go faster. We tend to be taking quite small minorities. Because the founders it's hard being a founder, right? So the founders need to have lots of the equity. The team needs to have lots of the equity. So if we were coming in and saying we're going to put 3 million quid into this early stage business, but we want 80% of the equity, well, there's only 20% left for everybody else. Yeah. That doesn't feel like a great way to make money.
And in that example, did you sort of sell out completely? And, you've obviously, sounds like you must have made a very, very good return on your initial investment, or do you sort of stay in, even though the business is now worth, did you say $1 billion?
Yeah, $1.5 billion when I raised money last time. And it's always hard, isn't it? Like, how do you value these things? That's what it was valued at 2 years ago. And the business has got better, bigger, market's less positive. I wouldn't know. You'd have to go to test the market to get a valuation.
So when you put your money in, do you put people on the board, or do you just stand back and watch, or how does that work?
We think chairs and non-execs are really important. So the person that
me too, by the way.
Yeah, the person you can add to a board that's sort of not been there and done it, because we don't need somebody doing the same thing, but someone who's got experience of the strategy you're trying to execute. So if somebody says, I want to go and open up so Tonkotsu, we talked about the ramen chain, you called it noodles, but it's ramen.
We'll never call
very passionate
ramen noodles. Sorry.
Ramen. Yeah. They're very passionate about it being ramen. So the 2 founders, Ken and Emma, had founded that business. It got to 9 sites. Great individuals. The offering was perfect. The price point was perfect. The way they rolled out the stores was perfect. We introduced Sarah Willingham, who's a very, very well-known restaurant entrepreneur, and Sarah's rolled out chains many times before, restaurant chains. So we add Sarah to the board. We do that together. We appoint the chair together, and then one of us joins the board as an observer to help with the strategic bits and pieces. We're not in Tonkotsu serving ramen or coming up with the menus. That's the management.
And how's that one going?
Yeah, it's gone really well. I think they've just opened their 21st site.
Wow.
So it was really funny with Sarah, and she wouldn't. I don't think the team would mind me telling this story, but I can tell it anyway. Sarah had been on the board for a few months, and she was sat. I met her for breakfast, and she just said, "There's just something wrong with the menu. Like the pricing on the menu's just not quite right, and I can't quite explain to the team what it is." And I was like, "Oh yeah, cool. I don't know how to do that." And I think in the end, Sarah went and spent 2 days in a kitchen, like doing the food to work out what it was. And it was just some of the split between protein and carbs and veg and stuff, just nibbling around the edges on different things. We'll put a bit more of that in there and a bit less of that in there. That's the value that a chair who's been there and done it can...
Can I flip it the other way around? Because in one of the other episodes that we did, we interviewed a fascinating founder called Maxine Laceby, right, who ran Absolute Collagen.
Yep, I listened to it. It's
right.
good.
And we were asking her, right, there were a lot of people pitching you for money because obviously a decent business has a choice, right? And how did you choose the one that you wanted to? And it wasn't in the end about numbers. It was about, I've got to spend the next 5 years of my life with this person. Who do I want to spend my life with? Which kind of moves you into the emotional intelligence rather than spreadsheets and IQ. What's your view on that?
Yeah. So
and what's your background, by the way?
So my background's very different. I grew up in a town called Corby, so an old steel town. I wasn't the best behaved at school. I probably could have worked harder. I definitely could have worked harder. But I was sort of quite street smart. And then I didn't do particularly well at my GCSEs. I managed to sort of convince them to take me into the sixth form to do A-levels. It's just a comprehensive school. I did my A-levels. I didn't do very well at my A-levels. I went to the University of Wales, Bangor, in North Wales, because if I was in an interview, like a job interview, I'd tell this really beautiful story. But in reality, it would take me with 3 Ds and a C. And I went to Bangor, and I was carrying on the trend of just being a bit of a loser, really. Partying too much, drinking too much, wasn't too bothered about going to lectures. And then I met a girl in the January of the first year of university, and I quite liked her. So she was quite a good stabilising influence. And I sort of got I probably do need to work a bit harder here. So ended up getting a 2-1 at university, taught my way into a grad scheme with a bond trading house. Wasn't very good at that. I was trading 5-10-year Eurobonds. Sounds very exciting. I just wasn't very good at it. Needed a job, so I wasn't very good at it. And they basically said, "Look,
you did avoid going to jail in the financial crisis, by the way."
I did.
So
that was good.
That's a good thing.
They sort of said, "Look, you're not very good at this. You can either wait until we sack you, or you can just sort of take the leap yourself." So I left there. I went to RBS as an analyst. I moved from RBS to Lloyds Bank because they were paying more money. There's no better reason than that. And then I was very lucky in about 2006, I was asked to go on a sort of outward bound walking weekend with the restructuring team, met the head of restructuring, and then he pulled me into the restructuring team in sort of late 2006.
See, what's interesting there is some people have this misconception that it's fantastically clever numerate modelers who went to private school, right? And you're kind of the council-house boy from Corby, who started off not terribly great, but you got on as much through personality as mathematical ability.
Yeah, I work really hard. So
you think that kind of balance is needed, that you've got to have some really clever people, IQ people, but you've got to have others who understand the emotional intelligence bit, because people deal with people at the end of the day, don't they?
Yeah, the balance is you need many more EQ people versus the IQ people, right? So
you need more EQ people.
EQ, yeah, absolutely. So I will hire into YFM on EQ. I can teach people how to do numbers. I can teach tangible skills. The tangible bit of what we do isn't that hard. The bit that's really hard is what we would call winning over a management team, making a management team want to work with us.
That's the opposite of what people probably think, isn't it?
Well, you did say earlier, and I latched onto it. I think you said you weren't a numbers person, right? I think you're underselling yourself, because obviously you work for RBS, you work for Lloyds Bank and the rest of it. So you do know something about numbers, right? But it is interesting that these management teams come into you, and I think what we're learning is you triage out loads and loads of companies before you latch on the ones that are interesting.
Yep.
And then much more of the decision making is around the quality of the management and the individuals you meet. That's really where it's at with YFM.
Yeah, absolutely. And as companies get bigger, that is different, because you can go and recruit management teams in.
Yeah, but the bit that's a bit different there is we often talk about what's the quality of the management team, whereas you seem to be concentrating on, my guys have got to be seen as the good guys, right? We've got to make friends with these people, which is not... People think of investors as being, hungry money people, right? And you're saying, no, people won't choose us unless they like us, I think is what you just said.
Yeah, absolutely. So you referenced Maxine. So Maxine is going on a journey. So use a relationship analogy, right? So you meet your partner, you get to know them a little bit, and you decide you'll spend a bit more time together, and then you get married, and actually you realise that the way they were before they got married is probably how they're going to be once you're married. It's like that with an investor. So we're trying to show, we meet a team, if we like the business, we are full on sales mode for them to choose us. And we're trying to show to them that not only are we good, nice people you're going to want to spend time with, we're going to give them lots of examples of where we've added loads of value. We're going to give them lots of examples of when times it's gone wrong. So how do we behave when it goes badly? Because it does tend to have a bit of a dip at some point on the journey. And we're working really hard to say, look, we're going to pay you the right price. We'll pay you the right number because the advisors will do that. The advisors will tend to get the numbers quite close together. We just want you to decide we're the right partner for you when we give you that offer.
And how do you add that value? What's the secret formula, the magic formula that makes the difference?
So I summarised, everybody has their own different view of this, interpretation at YFM of this. So I summarise it as we create the environment that makes management teams spend more time on the business rather than in the business. So that then looks like board meetings and board packs, and that all sounds really boring. But actually it's about saying once a month we're going to sit in a room together and we're going to do a proper board meeting with the chair and the other execs, non-execs, whoever needs to be there. And we're just going to talk about all the strategic stuff. So we're going to have a board pack. We're all going to have read the board pack before we get there. So let's not turn the page of the board pack. It's going to be some numbery stuff in that board pack because the numbers tell the story, but it's not about the numbers. It's about
that's very interesting, but because I chair another business, and at the risk of telling trade secrets, we've actually separated the numbers out into a different meeting. We have an operational review, and then we have a board meeting, and the board meeting just talks about strategic things and projects and things that we're fixing to make things better.
Yep.
Because otherwise you spend your life looking backwards, don't you?
Yeah, so the numbers are the score of what you were trying to do. So we've sort of got to look at that. We do have to look at cash. That's quite important. We will need to make sure there's enough cash to keep going. But then we want to be like looking forward. So we do a strategy day every year where we do the proper, let's just spend one day thinking about the big hairy goal. And then each month we're just checking in on that strategy day. Is it the right one? Are we going the right way? Have we moved? We've done another.
So you're almost acting as mentors, really.
I think we're a mirror. So often a founder will come. When you build really great relationships, they tend to spend a lot of time on the phone. So they'll ring and say, "I've got this problem." They're like, "Oh, okay." They'll talk you through the problem or the thing, and you talk, you listen, you share stories of what you've seen elsewhere. I often don't know the answer to the problem. All I'm really doing is reflecting back what they've told me, because most leaders know what they've got to do. They just want to check it. They just want to talk it through with somebody. If I'm telling them what to do, the relationship's probably not the right.
See, I find that really interesting because I was blessed with a fabulous mentor and chair for 25 years. And when I look back at what he did to me, I think he taught me how to think. Because what he would say to me is, we'll talk every week, and all I want to know is what problems have you got? Don't ever tell me you haven't got any, because that means you don't know what's going on.
Yeah.
He said, when I ask you what options you've got, don't ever tell me you've only got one, because there's never only one. And then tell me why you've chosen number 2 rather than 1 or 3, and then I'll say, fine, you've clearly thought it through. And it was in preparing my mind for that meeting, right, that helped.
Yep.
Right. And that's effectively what you guys are doing, isn't it, really?
Yeah, absolutely.
You're training people how to think.
Yep. And we give them the structure, because we say the thing we've got to do today is the strategy day. If you're an entrepreneur running a business, it's busy. There's always a fire to fight. How do you ever prioritize the big hairy goal thing when there's the dishwasher's broken downstairs, there's orders that are late, your sales team's a bit behind? That's hard to do unless you're super disciplined, or you have a third party that's saying, actually, this is part of the deal we did, is we're going to do this. This has to be important. And what we're going to do is we're going to put money into the business that allows you to recruit the person who's going to fix the dishwasher, get the sales done, do the orders.
It sounds completely obvious that, but, with experience of working with many, many businesses, that ability to sort of track, you said you were going to do this, a month later we have the board meeting, actually nothing's happened, which obviously happens in all businesses, happens in our lives. We say we're going to fix the shed and, 6 months later we haven't done it. That ability to track that performance on a sort of programmatic basis sounds like it's not rocket science, but it doesn't always happen with private equity, does it?
No. It doesn't happen in our own business. I mean, we're the worst. I mean, there's all sorts of big strategic goals we don't get to. Nobody's not doing stuff because they don't want to or they don't respect it. They're not doing stuff because other stuff's in the way. So for me, there's the 100-day plan stuff we work to, and they say, well, yeah, I'm behind on that. Okay, fine. Or, I'm sorry, I'm behind on that. It's not sorry. Let's just understand what it is that's getting in the way of doing that. Because if that's the other thing's more important, well, let's talk about that here. And if the other thing's not important, let's get somebody else to do it.
You talked about some of the great successes. Is there one that got away where you just didn't invest in a business that went on to be, well, we had Skyscanner, didn't we, in the last series as one of our absolutely super, super successful businesses, for example. It went okay, yeah.
So the shoulda, woulda, coulda portfolio. So I really discouraged the team from thinking too hard about that stuff, because just because somebody else invested in it, it doesn't mean if we'd have invested in it, the journey would have been, it's all sliding doors moments, isn't it? So the one that gripes me, and I'm going to be I'm not going to talk about it in too much detail because of the reason we didn't do it, but there was a business that sold a product into data centers, and there was just something very special about that business. And the product was great, the referencing was great, the customers were great. The hyperscale data centers were just becoming a thing in Europe. They've been in the US for a long time, and they've got some really great customer references, and it was just an awesome business. But it had been run in a very entrepreneurial way for a long time. So we really wanted to do it. We worked really hard to do it. We got it into exclusivity. It went into due diligence, and there was some stuff in the due diligence, and we were talking it through with the founder, who I still see, who's a really, really great guy. And we just couldn't, there was just so much to do. And we were sat there going, the risk reward now is starting to go a bit too far the other way. As a management team who were great, but the founder was like, I want to take a majority of my money off. He's like, yeah, but there's all this stuff that's got to be sorted.
And you didn't do the deal.
We didn't do it. And then, of course, that business, AI has been massively helpful to that business. So it got sold for a huge amount of money a couple of years ago, yeah.
Let's finish by getting really positive and concentrating on tips for people, right? I think when you say only 1% get approved, then clearly people have got to do the homework to say, right, I've got to be good at this, right? So if I'm coming to pitch to somebody like you, what's the 3 or 4 things that I've really got to do to tick the boxes? And what's the one thing that please don't do that?
The one thing please don't do is don't come in and tell me the story you think I want to hear, because it doesn't last. Like, there's no point starting off on a journey telling me all this stuff because you think it's what I want to hear if that's not real. Because if we do go forward, we're all going to work out.
You'll find out
real.
Anyway what the truth is.
Yeah, and it's not lying. It's very rarely lie. I don't think it's ever lying. I think it's people just want.
Be careful of exaggerating too much.
Yeah, I'd like to not have that. Share the information in advance. So you'd be surprised how many people say, well, I'm not going to send you a deck or anything because I want to talk about it in the room. You're like, it's cool if that's how you want to do it, but it means I can't prepare. So I can't be informed. So one of you mentioned earlier about founders having to educate us on the market. I mean, if one of my team turned up to a meeting having not done a bit of research on the market, we'd be having a difficult conversation. So I do think we should be well prepared for meetings with management teams. We can only be prepared.
On a pitch deck, how long should it be? 5 pages, 50 pages?
Definitely never 50 pages. 10, 20.
10 to 20?
Yeah, if that.
And how long have I got to pitch? 15 minutes? Half an hour?
So I use the word pitch, and it's the wrong word because they're not in pitch. I just want to come in and tell their story. So an hour, 2 hours, 3 hours. I've gone and done first meetings that have taken all day, where we've just sat there. The conversation's flowed. We're interested in the business. They're interested in us. The business is called London Drainage in our portfolio. A colleague and I, David, went to see them, and they introduced us to everybody in the business. The founders were just like, let's just introduce you.
Yeah.
What it sounds like is, this is not Dragon's Den. You don't walk in and pitch to it. It's not like that. This is just sitting down and explaining what you do, why you find it exciting.
Yeah. And you don't want the wrong investor. So if they come in and tell their story and I don't get the story, they will feel like it's me saying no. So the 99% that we don't do is because we're the wrong investor. They don't want us. You shouldn't want the wrong investor. That's not going to work. So yeah, it couldn't be more different to Dragon's Den.
I mean, I have to say, Jamie, it's been great to hear the story. Great to hear your story, by the way, but also great to hear that you are sticking to your knitting, backing, great smaller companies and growing them, because not all private equity funds have taken that strategy, and it's to your credit that you do that. It's been terrific.
Thank you.
Chatting to you. Thanks very much.
And I think the
coming
other
in.
bit that I really learned from this one was you don't need to be that big to actually go to somebody like you for help. Everybody makes that mistake of struggling on their own when they don't need to.
Yep.
Jamie, it's been an absolute pleasure. Thank you much indeed.
Thank you. Thanks for having me.
This episode was designed to be a masterclass in private equity, right? They're not all the same. It's a bit like football, isn't it? With the smaller clubs and giant clubs. Can you just explain how the various strata works?
Yeah, and YFM, clearly, they operate at the small end of the market.
They're an introduction to private equity.
They are, but they are a private equity fund. So the mentality is, they're generally taking, I think, minority stakes in businesses. They're not owning businesses.
They do own some of them.
But they'll also do, minority stakes. But the reality is, they are operating in the same way as a bigger private equity fund. So what you tend to see is there'll be people like YFM at that part of the market for small businesses. There are mid-market, what you call mid-market private equity funds. They may put 50 million into a business. And there are the giant guys, the CVCs and the Apaxes, these sorts of people who can write enormous checks. And there are lots of different grades of private equity. And they have particular specialisms depending on the size of check that they write, effectively.
So some of them are sector specialists and some of them are generalists. So I think what you just said is the ones who are buying the really big businesses have got the biggest funds, but by definition, haven't they? What's the... He explained that they typically get their money from either pension funds or private wealthy people. What's the typical lifetime of a private equity fund?
Yeah, you'd normally expect to have a 5-year fund with a 5-year runoff, but accepting that, if you reach year 5, so you've raised £200 million, at the end of year 5, if you haven't sold any businesses, you bought 10 businesses, you haven't sold any of them, you'll be under pressure from those investors, those pension funds, to start selling. And you've got a period to sell the assets. And what the investors look for is the rate of return on their money. A bit like the interest rate, if you like, if you put the money in a bank. And they typically would expect to see anything from 15%, which is low risk, to maybe 30%, which is high risk. And a lot of private equity funds would look to try and achieve a return on that money. This is an annual return of maybe 20 to 25% annually over a period.
So that equates roughly to 3 times the money over 5 years?
2 to 3 times their money. And that's literally a multiple. I put £1 in and I get £2 out or £3 out.
And how do they do that typically? How do they make so much money so quick?
Well, they really make it by selling businesses or selling shares in businesses. But each year, private equity funds will value those businesses on a portfolio. It's a bit like you having a house. And, every year you might say, what am I worth? What's my house worth? And I'll look at all the other houses in the road and I'll say, have they gone up or have they gone down in value? And that gives me an indication of what my personal wealth is. And that's what private equity funds do. If they haven't sold a business, which is called a realization, then they'll do an exercise with an independent firm to value those assets on their balance sheet effectively.
In some respects, it's more like an American approach, isn't it? We're back to the growth. Unless they can see it growing 3 times quite quickly, then they're not interested. Sometimes I hear people talk about sweet equity pots. What does that mean?
Well, that's really equity for management, for the people running a business. So quite often private equity will invest, and particularly someone like YFM, they'll invest in businesses owned by entrepreneurs. So YFM probably very often will invest in, they'll be the first time investor. So the management own 100% of the business, but they might have brought in new people. The guy running it or the woman running it, they might have decided they needed extra help. So they bring in someone who wasn't fortunate enough to be on the train when it left the station, right? And they don't have shares in the business or only have a small number of shares. So you put in place a share incentive scheme. You basically give free shares to people in the business who are particularly important. And those shares are valued at the price at which you do the deal with YFM. And then obviously if the business was worth 100 and you sell for 300, the difference between 100 and 300 is where you make the money for the management.
Okay, so when they often say, look, there's some gaps in your management team, we know some really great people, they also know how to put incentive plans together to get them in.
Exactly that.
I think that was a great introduction to private equity.